Howdy, y'all. Obviously, been a wild few weeks in mortgage rates. We are back to the October highs. I am with you today from my new command center, the Fields Lane Clinton Command Center out here in Oak Ridge, Clinton-ish sort of area off Old Batley. And hope to be doing a lot more content from now that life's a little bit more settled down for me. Um, Folks are really worried about what's happening with mortgage rates. Getting calls from realtors. Obviously, it's a big topic in the office. And one of the reasons that there's confusion, concern is that unlike October, okay, when we hit those 20-year highs for the first time in mortgage rates, we knew what was driving that. It was inflation, right? This is different. So we've in general had moderate to good news on the inflation front for the past couple of months, yet rates have done the opposite of what most people expect. So I didn't really dig into this. I've been busy moving, been busy with pre-approvals. I've been a busy boy. But I did some reflection this weekend and I realized what's driving this. And something that you always have to remember when we're talking about trading in financial markets is that declines or inclines in the price of a good are not driven by events. They're driven by the wants and needs of the participants, okay? And by far the largest participants in the bond, whether we're talking about 10-year treasuries, treasury bonds, mortgage-backed securities, are banks, pension funds, holders of massive amounts of money that move markets. It's not individual traders, retail traders. I mean, they will do the little bits on top. They do not drive the underlying theses behind price movements. So what changed in the past 3 weeks? We look back and we see that on July 27th, the federal government announced a new accord called Basel III Endgame. It's a new set. There was originally Basel III put out to establish a preliminary set of capital rules for banks. Basel III, quote, Endgame, I don't know what they're trying to do there. I guess it's like the Avengers of finance, set the firm plan for what the government's going to impose on banks for what they must have in liquidity. Now, the problem is that liquidity is a little bit on the rare side right now. When money moves to money markets from depositors, they move from checking accounts to money market accounts, the bank gets more restricted access to that. They're not able to count it as much capital. And ever since federal funds rates started skyrocketing, people have been moving money in massive amounts to money market funds. So liquidity is getting drier, okay? What this means is that as their liquidity starts drying up, they have to maintain a larger balance. That money has to come somewhere. So these banks that have invested in MBS, 10-year treasury, all of these bonds have to start liquidating. They are forced sellers to start motioning towards compliance of this. Now, the rule isn't implemented yet. There is still time for commentary on it, but the moral to the story is that banks can't take that risk. If you wait until the rule is finalized, then you are way off sides when it actually comes down. So here's the good news and bad news. The good news is this is not going to drive drastic movements on an intraday basis. The bad news is there is no particular time frame for when this will end. It does mean that when Basel III, this final endgame, gets finalized, that it'll be a more muted response in the market. If there are some changes, there will, especially to the positive, there could be some real positive. It's the negative. It won't cause a drastic movement. But this is, for some of these banks, I mean, you're talking about now expanding from compliance from banks that have 250 billion market cap. Now those liquidity requirements are going to apply to banks as low as 100 billion in market cap. And that's a pretty significant population of banks. Let me show you how to track this down. Just share my screen real quick. And here's what we've got. This is the Basel III again. Just Google BASEL III if you want to track it down. But I want to show you the market movement since July 27th. Looks like we're going to have to refresh this. Come on, TradingView. I need you to subscribe. I need to get lazy. All right. July, here we go. There we go. 27th, big old red candle. That was the date of it. And now we look at the velocity of this movement. The velocity of this movement is still significant, very high. If you look at this right here, if you talk about day-to-day decreases, is only matched by a couple of events. So, for example, this was a terrible inflation report in February. Terrible one we got right here. Awful, right? Drove things down. This is where the bank collapses happen, right in here. Now, as the financial system stabilized, then we start moving back more to this midpoint. You see, you've been trading their range. You're almost exactly as the midpoint. And we broached this, came back down here. But here's Basel III. So this is the day before Basel III right here. And we are still roughly in range with trading expectations right there. Could there be a movement to the downside? Absolutely. But Basel III really knocked down. Watch this. Yeah. Monster volumes around Basel III. If we scroll out, check this out. Volume on virtually nothing here. These vol numbers, and if you look up a little bit leading up to Basel III, because it was suspected that there were some leaks of this information, the volume is just absolutely off the charts. That means there's a lot of active sellers in the marketplace. These are not event driven. These are by people and institutions, well, not people, but decision makers at institutions that are forced sellers to start to try to get back over the line, stop being offsides, and get their capital right for compliance with these rules because they know it's happening. I wish I had something more encouraging to say. I think this unwind, it's not unlike April. So in April, I made a call that BlackRock was unwinding some bonds from Silicon Valley Bank, which caused a little bit of a spike there. Made a good bundle of money off of that. I'm not trading this though, because there is no defined expiration date. I don't know who these market participants are. You don't know. Nobody knows who these market participants are, but we know that there's a need to sell. And one other thing, let me see if I can demonstrate this pretty easily. Let's go back to sharing. Get this chart back up. Let y'all see something. If I can look at a longer term. Let's do this on a 1 month interval. That's ugly, right? We do only go back to August 22. What I would have displayed you if TradingView was cooperating right now is that ever since the federal government stopped its bond buying program, volatility in the market has been huge. So what we call IV. It has been a monstrous increase in it. So just the amount that the market moves every day, because you don't have this huge forced buyer, the federal government, of 10-year treasury, mortgage bonds, everything else. The market still hasn't really adjusted to that. I mean, it has been 12 years since the government has not been a market participant in bond and MBS trading, especially in MBS, much more shallow field. The loss of that market participant has made wild swings from day to day. So when you have an event like this, that there's forced selling going on, there's a must to get this stuff off your books. When you don't have that massive backstop in the terms of the Fed, it is a huge repricing event. Maybe I called Nick, the boss, right here at Foundation. I said we're going to hit 8%. It's coming. And I think that's a combination of factors. I don't think we go further than 8. 8 is really just an abstraction. We're really talking about mortgage bond prices, but there does come a point at which a buyer is going to show up. Pension funds love to lap up long duration, high yield, risk-free products. And pension funds are still working at getting their balance right between equities, which they're overweight on for years, back into fixed income. There is a price at which the buyers will return. I don't think that price is here yet, though. So I've been telling, as the folks I've talked to, was more optimistic on this after last October, November. Inflation looked like it was coming in the right direction. I was like, I think we're about a year out, right? I thought about October, November this year, we'd start seeing the break of the storm, start seeing maybe the terminal rate from the Fed would have been about a half point lower than we are right now. We would have started coming down a little quicker. I'm much more bearish now. I feel like we are not going to see meaningful movement until mid 2025. It's going to be a while. If you are a mortgage loan originator like myself, hunker down, get your personal stuff in line, get ready for some more low income years. I've made adjustments myself to limit my personal spending, things of that nature. But if you are in the finance industry, I think it's time to hunker down. The beautiful news is if you are in finance and you stay in finance and you keep up in this fight and you work harder for less dollars, when this does turn, it's going to be unreal. It's going to be something. So, to my realtor partners, sorry, I don't think mortgage is going to help you out very long. The good news is, I'm a pretty creative dude. I can usually come up with some ways that we can help out with payment, if not permanently, at least on a temporary basis. Have a great partnership with Oak Ridge Federal Credit Union, Alarno Federal Credit Union. Love them. Keeps the rates on those customers way down. Holler at me if you got questions. I love talking about this stuff. And if blessings be on you, because I know it ain't been easy.